So it wasn't exactly one of the most bullish of weeks, with both the Nasdaq and the S&P slumped in the red, which clues us into the overall sentiment out there on the street, following all of this AI hype. But given our financial freedom journey and the mission at hand, I want to steer clear of all the noise, just break down the need-to-know macros with you, and then dish out 6 dividend stock opportunities that you, at bare minimum, should have on your watch list right now. With that, are you ready? Now, as mentioned, this past week really wasn't anything to tout about. And for the most part, we hovered in the red across indices. There was not a whole lot of pressing news bites, and overall, the forecast on Wall Street remains quite cloudy, with a chance of little to no clarity out of the Federal Reserve. Now, that leads me to talking about some of our need-to-know macros. And I want to start with some positive news for you, which is that the Federal Reserve gave their stamp of approval on the big banks that should we find ourselves in a recession, they're saying that big banks can actually withstand the turmoil as they pass their stress test. However, that R word, recession, would nonetheless set off alarm bells, and man oh man do I hope that that word is tossed around again, because that would spook away a lot of investors and then I'd get to double down on some of the positions that I want to. Now additionally, on Friday we had some inflationary data to mull over, the Personal Consumption Expenditures Report, which measures how consumers are actually spending these days. But the only thing I really want to share is that report by report, there really hasn't been any significant directional shifts which would lead the Federal Reserve to a more dovish stance and ultimately allow them to cut rates. So until then, investors, I'm afraid to say that unless this book on inflation is finished, closed, and then put back on the shelf, we're just going to be in this sea of volatility ebbing and flowing. However, being that we are investors, that is actually exactly what we need and should definitely want. Moreover, in picking high quality stocks for the long term that shell out dividends, well, we can't really lose. So how about we just get to it here and get kickstarted with our dividend stocks to add to your watch list. For the week ahead, in no particular order, let's go ahead and start with Parker Hannifin, ticker symbol PH, which is a global provider of motion and control technologies and integrated across verticals, from aerospace systems to adhesives and coating and seals to pumps and refrigeration. In other words, we're talking about a company that is involved in your everyday life that goes quite unnoticed, thus making the exact type of boring investment that I'd actually want to get into. But we're here for the opportunity, which means it should be in the red, and that's exactly what we're seeing now, as it's trading just over $500 per share, which is down by almost 10% from 3 months ago, a PE right now at 23.8. But zoom out, you're going to see it was in the green all year with the expectations of a better economic environment. Zoom out even further another 9 years to see Parker Hannifin's real power soaring by over 372%. Now, as for analysts right now, they forecast upside with the share price climbing to about $612.92 per share. It's over 23% worth of upside from here. And now we talk about dividend growth because it's shelling out a 1.3% dividend yield, yet growing that dividend by 13% on average year over year, and a very nice track record over the last 67 years. Next up, an atypical mention for me at least, as I don't normally pitch a lot of growth-oriented opportunities here on the channel, I do want to talk about Salesforce, ticker symbol CRM, which is a software company that's focused on customer management. In other words, whether you're in sales, customer service, marketing, analytics, or really anything in between in the corporate world, I am sure you are familiar with Salesforce. However, it is on today's list because it is trading right now for $243 per share year to date, which is down by over 7% on the year after reporting some horrid earnings. But zoom out with me here to see over 311% worth of appreciation from Salesforce over the past decade, which should prompt your green flag to go up after you come to understand that not only is tech entirely cooling down right now, but after a brutal 2 quarters, whereas interest rate cuts were pushed back repeatedly, resulting in big businesses, whether you're the Fortune 500s or even the mom and pops, to scale back on their spending, it just makes total sense that Salesforce actually took a massive hit. But I, along with the analysts out there, doubt this environment's going to last forever, so remaining long on Salesforce, we can see a forecasted share price by top analysts topping $295 per share, which is over 21% worth of upside upside, all while insiders have been buying as recently as June 24th at the director level with almost $500,000 purchase, and then again back in early June with a whopping $99 million purchase, again by a director. Not to mention, we see a ton of hedge funds also turning bullish on Salesforce now too. And until the big turnaround, while you won't get a crazy dividend yield with Salesforce, you will enjoy a sliver of a dividend thanks to that yield coming in at 0.66%. But if Salesforce is not exactly in your comfort zone or too growth oriented and you want to go for reliability, check out Kroger, ticker symbol KR, which operates grocery and drug stores throughout the United States and has been in operation since 1883. Now, Kroger really hasn't been as heavily hit as some of the other mentions in today's video, as it remains right now in the green this year, trading for just under $50 per share. And more importantly to note is Kroger's steady growth over the long period of time, with over 140% worth of share price appreciation over the last decade, while capturing analyst optimism right now through the good times and the bad times that may be out there. Its current target share price is coming in at $59.13 per share. That would be just under 20% worth of upside from here. And until then, as a Kroger shareholder, you're going to go ahead and reap the benefit of Kroger's dividend, coming in at a 2.35% yield after 17 years worth of uninterrupted dividends, all while growing by an average of 14% year over year. Now, investors, before I cover the next 3 dividend stocks, I am calling on all of you to effortlessly help me by tapping on that subscribe button to join me on this financial freedom journey. You see, I have a goal to get at least the 73% of you out there who aren't subscribed down to 50%. Already from about last week, we notched down by 2% from about 75%. However, it literally takes a village to not only grow this channel, but achieve financial freedom. As this channel continues to grow, I'm only going to make you this promise. I'll work my tail off to deliver through on more dividend stock ideas, share deeper depths of market insights, and secure better guests for masters of the market, all for you. But it requires your help. And while you're at it, go ahead and let me know that you're getting value from videos like these by tapping on that thumbs up button, and that would then prompt me to continue to make more content just like this. All right, let's get back to it here with the next dividend stock opportunity, which is Genuine Parts Company, ticker symbol GPC, which is in the business of automotive replacement parts as well as industrial components. So another under the radar type of company hardly thought of that makes our world go round, which is why after it slid to $138 per share from over $160 per share, I'm excited to share that this is an opportunity for you, especially with this PE ratio now at 15.5. But zoom out to see over 108% worth of share price appreciation over the last decade, while analysts right now are calling for almost 24% worth of upside, hitting a share price of $171 per share. And until then, this buy and hold machine will be printing money with a 2.9% dividend yield, all while steadily growing by an average of 6% while maintaining a 67-year dividend streak. However, if you really want some firepower for your portfolio in the near term, while also gaining some serious upside potential over the course of the long term, there are 2 dividend-paying stock opportunities that have recently just been getting all of my attention because of the geopolitical affairs around the world, especially as it seems Israel is going to be facing yet another war, this time on the northern border with Iran's terror proxy group, Hezbollah. Now, both of these next 2 dividend stock opportunities have upside potential because of all of this mayhem. I'll disclose the first one being ExxonMobil, ticker symbol XOM, because as an oil and gas behemoth, anytime the Middle East makes headlines, we see spikes in the cost of barrels of oil, which has a ripple effect worldwide and then causes ExxonMobil to charge more at the pump, which does wonders for ExxonMobil's bottom line and share price while sucking the funds right out of your wallet. Either way, Exxon, because of the global crisis, has actually been performing quite well on the year, trading for $144 per share. That's up over 16% worth of appreciation there. And zooming out to the 10-year, we can see over 74% worth of appreciation. And should things only heat up, which is very probable, analysts just see another 17+% worth of upside, climbing to $134.71 per share for Exxon. But another indicator here for us all to review with Exxon is the insider activity, to which we see at the director level an insider recently scored over $2 million worth of the stock, all while hedge funds have been going nuts, scoring 13 million plus shares worth of Exxon last quarter. Yet the best part of investing into Exxon is the dividend. As a shareholder of Exxon, you're going to get that 3.32% dividend yield bonus that has been on an ongoing, uninterrupted streak for over 142 years, while consistently growing that dividend by an average average of 7% year over year, which is not too shabby if I may say so myself. But should World War III actually really break out? Investors, my best bet and dividend bagger is with the one and only Lockheed Martin, ticker symbol LMT, the largest defense contractor in the world, with Uncle Sam and Allied Forces as their clientele, manufacturing essential military-grade vehicles and aircraft. Now, this company does not ever really miss a beat in terms of opportunities when it comes to securing contracts. Recently, it locked in a contract for $283 million, and a missile deal with the federal government, a $2.27 billion contract with NASA, and another $1.93 billion deal with the U.S. Army. And as business booms, well, Lockheed only continues to report solid earnings, with revenue that just topped 8% above Wall Street's expectations. Now, think if Biden and Trump go head-to-head and Trump actually comes out on top, well, I think he's going to double down on military spending. And, well, ka-ching, ka-ching for Lockheed Martin. As for the stock right now, not so terrible on the year, up by about 4%, trading for $466 per share, a PE at 17.1, and about 281% worth of share price appreciation over the last decade. Now, my call is that we're probably going to have another great decade ahead of us for Lockheed Martin. Analysts are predicting likewise, with a share price hitting $490 per share. Roughly, that's about 5% worth of upside to come. Now, this dividend with Lockheed comes in at 2.7% while maintaining a 31-year dividend streak, and best yet, it's got a heck of a growth rate at 16% on average there year over year. Now, investors, there you have them, all 6 dividend stocks. Drop your thoughts down in a comment below about all of these dividend stock opportunities. Let me know if they're in your portfolio, if you're planning on buying them, if you're avoiding them, or if you just have better dividend stocks in mind for the week ahead of us. Be sure you tap on that subscribe button while you're at it to join me on this financial freedom journey. And moreover, I'm going to allow you to just go ahead and click right here for more insights right now.